In today's video, I am going to be breaking down my favorite stocks right now that are listed on the American Stock Exchange, and of course for the second half of this year and into the future as well. So the first stock is Tesla. Tesla, I think, is severely undervalued for what it brings to the table. It's a car company, battery company, solar power, utility power company. It's so much. But when we're looking at the stock, huge volume, this is going to be a very easy stock to get into and out of because there is high volume. It has a very good beta as well as a pretty crazy high PE ratio, but to really think about it, it's like half the PE ratio it was a couple of weeks ago, so it's on sale right now. Its recent earnings call has been amazing, so overall, fantastic company so far. As we can see from this chart, even though it's crazy to say this, but this flat line was still very good during that time. You're looking at a pretty good growth anyways, because it did split. We have to remember that. And then since the split, it has gone an absolute crazy amount up. It's now currently consolidating. It's just recently broke through what I call a flag, so that's looking really good right now. And of course, its earnings for the last 4 quarters have been pretty good, except for one quarter it did miss. However, look at the earnings and look at the revenue. Its first earnings positive year was last year during a pandemic, and its revenue is skyrocketing as well. This is what you want to see in a company. Obviously, the headwinds when it comes to Tesla is going to be processors, and of course, there's a worldwide shortage of processors right now. So they are essentially moving all of the processors from battery development for their power walls over to the cars so that they can at least still get cars out. So that is the struggle that they're having right now. That's a little bit of the reason why their stock price has gone down recently. But overall, what you're looking at in this company is the future, and the future looks extremely bright. Next is Nvidia. Remember, I just mentioned that there's a company, but a shortage worldwide. Well, guess what? Nvidia makes graphics cards and makes processors, and because of the shortage, their stock is going up because now they can sell their chips for more money, which means that they make more money, which is just absolutely fantastic. This one, however, does make a very small dividend. I wouldn't be investing in this company myself if I was looking for a dividend. I'd be looking for the growth in this company. Again, huge volume as well, and pretty large PE ratio, but we have to remember that there is a thing right now called the Internet of Things. We have to remember that when it comes to vehicles being electric, there's even more processors being involved in new electric vehicles. Everything is going to be more automated. You can even get a toaster now that is like Bluetooth, Wi-Fi ready and all this weird stuff. It's getting pretty crazy. It's called the Internet of Things, and everything is going to be so-called smart. Even cities are going to be smart. You are going to be starting to see more and more roads and even sidewalks, probably within the next 10 years, going over to what's called a smart sidewalk and a smart road, where then they can say, hey, this road is backed up, and they can now reroute people other ways. So that is kind of interesting to me, but overall, more and more items, more and more things are going to be using processors and graphics cards, especially when we start getting into artificial intelligence as well as these robots. And of course, robots are going to be a thing. They're eventually, probably within 20-30 years, are going to be a thing. Now that's looking really far off, but it's now starting to see the technology revolution. This is what we all thought was going to happen back in 1999, 2000, and then everything crashed. Will it crash again? Who knows? But at the same time, it's looking pretty bright right now. So it's just recently gone for a little bit of a run. So right now it's going to be most likely consolidating, as we've seen here and also back in July to the end of last year. Consolidated a bit, and then it's gone for another little bit of a run. Again, dividends are not massive, but they do tend to raise them slightly over the last couple of years. We can also see massive earnings growth. We've seen massive revenue growth, and The only thing that kind of worries me is the fact that revenue grew last year, but earnings didn't versus 2019. So that's kind of concerning, but at the same time, anytime revenue grows, revenue is king. Next is Shopify, which is a Canadian company. Now, of course, this is the Canadian stock that I'm showing you. However, you can also get Shopify on the American Stock Exchange as well. It's just the fact that I'm Canadian. I wanted to show the Canadian version of the stock. But again, this is going to be a fantastic company. It's a worldwide company. More and more businesses are going online, and the way you do it is generally through Shopify. So that's why it's a strong company. Not crazy volume on the Canadian exchange. On the American exchange, it's a lot better. PE ratio is quite high, but considering the growth that they're seeing, it's not that bad right now. It's kind of gone through a stabilization period and kind of hit a double top, so I would assume that this is going to pull down just a bit one more time, and then it's going to then accelerate. However, at the same time, we are buying this for the future. This is seeming to be, considering the sideways momentum or movement that we're seeing, seems to be a good time to at least start a position into. Now, when we look at the financials, check this out. This is crazy. Revenue just absolutely exploded last year. Will this continue? Yes. Want to know why? Because guess what? The internet isn't going anywhere. It's getting bigger, and because of that, this is going to continue to get bigger. Also, look at the earnings. Massive. Look at the past three years. Revenue growth, earnings decline. Look at the last year. Revenue increases massively, earnings actually go into the positive. And of course, Carnival, finally something that's not a tech stock, right? But Carnival is going to be massive again. It was a big company before, it's going to be a big company again. They just had their maiden voyage of the Mardi Gras, which is massive news because that looks like an absolutely fantastic ship, and hopefully my dad's channel may have some videos coming out very soon, wink wink, on that boat. But anyways, you can go check out my dad's channel. It's called Trip Reviews, and you can check that out on the main page of this channel. But Carnival is an absolutely fantastic company as well. We have to remember that they cut a lot of costs and they got really skinny because of COVID. Now, because of COVID, they've kind of figured out how to try and figure out how to make money with less staff and less overhead, and because of that, they're probably going to be making more money than they ever did before. So because of that, I think that this is an absolutely ridiculously great company to invest in. Also, to mention that if you own 100 shares, you get some cash type of deals when you go on a Carnival cruise. So if you have 100 shares, like I do, and like my dad does, then guess what? You get some onboard credits to be able to buy stuff, which is fantastic because guess what? Everyone wants to buy a shirt. Usually it's the shirt that says, my dad or one of my friends bought this, went on a cruise and all they did was buy this shirt type of thing. One of those types of shirts, you always have to buy one of those. Yeah, everyone's gonna buy stuff on the boat. If you go on cruises yourself, definitely grab 100 shares of Carnival. It's worthwhile. Massive volume because, of course, what we're looking at is just a lot of people buying in and selling, and anytime that there's high volume, it's going to be easy to get in and out. There is really no PE ratio because they ain't making money right now. And of course, the beta is just huge, mainly because everyone's piling into it because it is a recovery stock. As we can see, it was declining before the pandemic. However, they were still making some pretty good money during that time. And since then, they have at least recovered a bit to $21. They got under $10 at one point. I got in at around, I think it was $18 or $19. Plus, their revenue was going up every year before the pandemic, and of course, they just absolutely lost a ton of money during 2020, but that's going to turn around. There's going to be positivity. Anytime there's positivity, it's going to be great. So that's my picks, that's my thoughts. Anyways, I hope that these stocks, or at least these explanations, can help you in your investing journey. If it has, hit that like button, subscribe. Remember to do your due diligence. Research these stocks yourself. Don't just trust any random person on the internet. Anyways, I'll see you guys again next time.